Stop what you're doing. If you own Northern Oil and Gas, or really any energy stock for that matter, you absolutely need to see this breakdown. Last week, I dug deep into their latest SEC filings, and what I found completely shocked me. They just posted a catastrophic $500 million net loss for the first quarter of 2026. Yes, you heard that right, a $522.8 million black hole. For most companies, a headline like that means absolute panic. The market sees blood in the water. But as we're about to see, the real story here is completely upside down.
So ask yourself this bold question. How on earth does a company lose $500 million but still go out, buy massive new assets in cash, and pay out a staggering 8% dividend yield? It's literally like checking your bank account, seeing you are deeply in the red, and then strolling out to buy a multi-million-dollar mansion in cash without breaking a sweat. I know retail investors see these terrifying headline numbers and immediately hit the sell button out of pure fear. We've all been there. It's the most common trap in the market, missing the actual physical mechanics of a business because of a scary accounting metric. But I promise you a clear, actionable framework today. By the end of this explainer, you are going to know exactly how this financial engine actually works and whether this stock is the market's best hidden gem or a dangerous value trap. Welcome to the explainer. Today, we're diving right beneath those terrifying surface-level headline numbers of NOG's Q1 earnings. We're going to uncover the actual cash mechanics of this business and separate the paper illusions from the hard cash reality.
Here is our roadmap to figuring this all out. First, that shocking Q1 loss. Second, unpacking those paper losses. Third, the cash flow engine. Fourth, expanding north. Fifth, the dividend and debt balance. And finally, Wall Street's mixed verdict. Let's jump right in. Starting with Section 1, a shocking Q1 earnings loss, getting beneath that $522.8 million headline. To put this in perspective, just a year prior, Northern Oil and Gas posted a really healthy $139 million in net income. So when you compare that to this sudden $522.8 million plunge, it looks absolutely catastrophic at first glance, right? I mean, it's a massive swing into the red that demands a real explanation. And it gets even crazier. Their total reported revenues for the entire quarter fell to a mere $5 million. Just really think about that for a second. A multi-billion-dollar energy company reporting just $5 million in revenue. That brings us to the absolutely crucial why. How does hundreds of millions in revenue just vanish into thin air? Well, that brings us to Section 2, unpacking the paper losses. Basically, accounting versus reality. Now, what's genuinely fascinating about this slide is the juxtaposition. Look closely at these financial drivers. NOG actually had rock-solid physical oil and gas sales of roughly $540 million. The oil was pumped, it was sold, and the money was made. But that revenue was almost entirely wiped out by a $539 million paper loss on commodity hedges. Basically, their financial hedges against oil prices went the wrong way. Add to that a $268 million non-cash impairment, and boom, the profits just completely disappear from the income statement. Let's define what that impairment actually is, because this is a massive tripwire for retail investors. A ceiling test impairment is simply an accounting adjustment. You see, the SEC has these strict pricing rules for valuing oil reserves based on average trailing prices. When prices drop, the on-paper value of those reserves drops too. So the absolute key takeaway here is that this $268 million hit doesn't mean cash is actually walking out the door. It is pure 100% accounting. This brilliantly illustrates the difference between GAAP accounting losses and the actual operational reality of an energy company. On paper, they look like they're bleeding out, highly sensitive to price assumptions. But in operational reality, their physical sales and extraction are incredibly robust. Which leads perfectly into Section 3, the cash flow engine. Let's look at the actual money. Because despite that massive $522 million accounting loss we just looked at, NOG's net cash from operating activities remained incredibly strong at nearly $324 million for the quarter. Guys, that is actual cash hitting their bank accounts. This is the metric that actually funds the business, and it is firing on absolutely all cylinders. Let's look at where that cash is actually coming from. Notice how their physical production is perfectly split, literally half and half between oil and gas. This balanced commodity mix is exactly what drove those $540 million in gross sales we saw earlier, right before the accountants got involved and muddied the waters. Far from a dying company, their operations are actually expanding in a big way.
They hit a record average daily production of over 148,000 barrels of oil equivalent per day. That's a solid 10% jump year over year. They're seeing sequential growth, record volumes out of the Appalachian Basin, and get this, they closed a record 41 ground game transactions in just one quarter. They are aggressively busy.
Moving on to Section 4, expanding north with the Duvernay acquisition. This takes us to their latest major strategic move. While the broader market was sweating those Q1 headline losses, NOG's management announced a major entry into Canada's premier light oil resource, the Duvernay Shale. As a non-operator, they're essentially buying up slices of prime oil real estate.
Let's break the deal down. They're spending roughly $259 million using a smart mix of cash and stock to grab a 25% undivided stake in these assets alongside Parallax Energy. This move secures long-term inventory and immediately adds about 4,000 barrels of oil equivalent to their daily capacity. They are using that massive cash engine we just talked about to buy long-term future growth.
Let's check out Section 5, the dividend and debt balance. Basically, the investor's view. Here we have the ultimate fundamental balancing act for anyone looking at this stock. On one hand, NOG offers an extremely attractive 8.28% dividend yield, backed by a forward PE ratio of just 5.24, which makes it look incredibly undervalued. But as an investor, you have to weigh those juicy returns against a growing long-term debt load that currently sits at a hefty $2.58 billion.
And this is exactly why this matters to you. Your job is to figure out if this financial structure is sustainable over the long haul. You really have to decide if that $324 million in quarterly operating cash flow safely covers the cost of this aggressive debt-fueled growth strategy while they continue to pay out that massive dividend. It requires very careful monitoring, especially since they recently issued over 8 million new shares to help fund things.
Finally, Section 6, Wall Street's mixed verdict, growth versus hedges.
Unsurprisingly, analysts are completely split on this. Raymond James actually downgraded the stock recently. Their primary concern? Northern Oil's hedging strategy. They pointed out that NOG has locked in about 70% of its oil production for 2026 at around $70 a barrel. This means if global oil prices suddenly spike to, say, $90 or $100, NOG is going to completely miss out on those windfall profits.
It perfectly captures the double-edged sword of their entire strategy. The downside is exactly what Raymond James pointed out, capped profit potential in a high-priced environment. In fact, those exact same hedges caused the massive $539 million paper losses we analyzed earlier. But the upside? Absolute stability. Those hedges guarantee the baseline cash flow needed to comfortably pay that 8% dividend and fund major acquisitions like the Duvernay deal, completely regardless of market crashes.
So I want to leave you with this final thought. We've looked beneath that terrifying $522 million headline loss, and we found a highly profitable $324 million cash engine that's driving massive international expansion. But we also see high debt and capped upside from some heavy hedging. So you tell me, is Northern Oil and Gas a complicated value trap just waiting to spring? Or is it the market's best hidden gem, comfortably paying you an 8% yield while you wait? Dive into the numbers and let me know what you think.